my friend Jim Sinclair used to say, MOPE, management of perception economics. I do believe that there are powers that be that didn't want gold going to the moon in the face of all of this chaos and a government shutdown. And, it's now you have, because of, I'm going to give you the names. I don't think we've talked about them, and we don't need to right now, but there were two failures recently, two big failures. One is called First Brands Auto Parts Supplier, and the other is called Tricolor Auto Subprime Auto Lender. And these are not isolated failures. These big companies failed, but they're they're private equity, and they're very much tied to the banking system. And the private equity firms that are way overextended and like providing loans to people who have no credit or bad credit, and they're way underwater. Yeah, it's private equity, but they also have deals with the regional banks, and the regional banks are now massively exposed. On top of all of these commercial real estate problems, we're beginning to see more problems in the regional bank system. And so all of this lending that's been going on to the overnight repo market lately has been done so through overnight lending of subprime real estate bonds instead of treasuries, which is the normal behavior. When you see something like that happening, the overnight repo market, think of it like a pawn shop. And normally they use high quality collateral, US treasuries, where I'm going to give you my MasterCard, or I'm going to give you something of great value, this gold coin, and I need to borrow the money overnight. I'll buy it back from you the next day at a little higher rate, and that's to get the liquidity that I need right now because I'm short on cash, but I have an asset. Well, now they're using subprime crap that is underwater, whether it be in commercial real estate or residential real estate. That's like stealing your wife's wedding ring without her knowing, because you pawned everything else, and saying, I promise I'll buy it back the next day. There are problems in the banking system, bad ones, and they're starting to manifest again. And I think all of these things coming together at once, there are some entities that didn't want the continued realization that gold has taken off, and the mainstream acknowledging it. And I want to talk about 4 or 5 things that I've never seen before in this industry ever coming out of the mainstream.
What are you hearing? Yeah, give us some of these.
So, if you were to ask your financial advisor my whole career, how much gold should I own? You might get 5%. And the rare bird would say no more than 10%, right? And that's been my whole career, 35 years. But I want to put things into context for people who are a little freaked out right now about the pullback in gold and silver. Now, over the last several weeks, maybe 3 or 4, I've seen 4 or 5 things that I have never seen and never thought I would ever see. We'll start with the chief investment officer of Morgan Stanley 3, maybe 4 weeks ago. Now, forever on Wall Street, there was what's called a 60-40 rule. 60% stock, 40% bond, put it into a managed portfolio, and retire happy. Now, since 1982, interest rates have fallen at a 45-degree angle. Anyone who did that did great, right? Bonds go higher as rates go lower. Stock market goes up as rates go lower. It was great. Everyone was happy. He came out and said, now this is the chief investment officer of Morgan Stanley. He says, no, it's time to sell half your bond holdings and go 60-20-20. 60 stock, 20 bond, 20% gold. Really? The chief investment officer of Morgan Stanley. Now, here's another one. Michael Hartnett. Michael Hartnett writes a newsletter. He is a massive institutional trader for Bank of America. His newsletter, I don't know how many, it's at least $10,000 a year. And it is only going to institutional level
people
traders.
Pay $10,000 a year.
Oh,
People
it's
pay
huge.
10 grand to get his newsletter.
Or more. I don't know how much it is, but it's at that level. And he's closest to the tip of the spear. He said, no. It's 25, 25, 25, 25. 25 stock, 25 bond, 25% short-term treasuries, 25% gold. This is the head guy at Bank of America.
Wow.
You have Jefferies. Now, Jefferies is they used to be Prudential Base used to be a primary U.S. mint distributor, and for all of the major mints of the world. And they nominated Miles Franklin 20 years ago to be an authorized reseller. Jefferies means a lot to me because Jefferies took over and it became Jefferies Base. And I used to work very closely with them, and they know metals very well. They were primary distributors for all of the major mints and refineries in the world. And about 7-8 years ago, they closed that division, yet they still know gold as well or better than anyone. And their head trader says, gold's next stop, not the only stop, but we're looking for 6,600 on gold. Now, maybe the craziest one of them.
When are they thinking that 6,600 is going to hit?
Mid-2026.
Wow.
And another trader at Bank of America said by mid-2026, he sees silver. Their new level for silver, Bank of America, is $66, with 56 being the average cost. Maybe the craziest one of them all is Jeffrey Gundlach. If you look up Jeffrey, he's known as the Bond King. He's made his entire living and fortune and name as selling bonds, and he just came out publicly and said a 25% allocation to gold is not overweight. So you have traders or people who are speaking to the highest level traders and institutional investors on the planet who are saying 20 or 25% gold allocation when they've never said more than 5. Now, when you put all that together with all the metal that's coming into the country at a level no one has ever seen before, never seen before, I would say to you that there's far more at play here than this being a top. There are banks that are massively short paper, and they maybe sold because remember I said they smacked the crap out of it, and then all of a sudden someone bought a ton. What are they buying? Are they buying the physical? Are they buying the physical to cover their short positions, to be in position? Are they trying to knock the wind out of the mainstream and get all these guys like Jim Cramer saying, yeah, the top, it's the top, or all the talk about, sell gold, buy Bitcoin. You get all this narrative to push everyone away from the attention that gold and silver, and rightfully so, have had.
Do people still listen to people like Cramer?
I'm sure they do. He's still on air.
Isn't that crazy?
I don't know why, but yeah, he still
they
has.
They even have the Cramer index because he's so bad.
Take the opposite. Take the opposite.
If you do the opposite of Cramer, you do way better than if you do, You
would have been better off following Paul Pelosi. Far better than following Jim Cramer.
Paul Pelosi is supposedly the best investor ever.
Yeah, of course. So no, I just want to try and put things in perspective, and I think this is a time where things are going to become more and more and more volatile. And this is a byproduct of it. And they want you to believe the narrative that, that gold and silver are well oversold. The funny thing is from a technical indicator, they are not oversold anymore. The gold had been oversold since August. It's not. And now it is undersold. Technically, we're still above a 200-day moving average. Technically, we have yet to see any lower lows. This is just a healthy correction and a scary one and a big one. But when you see it happen at a time when no rational trader would do it that way, if you're going to dump that kind of volume, you do it when the market has the most liquidity during New York trading, slowly over a period of hours or days or longer. You don't dump it all, bang, pour it onto the market when it's the most thinly traded, where it is done for effect. And that's exactly what has happened. The problem is most people don't see it.
It didn't work. It's not going to work. It's because the environment.
Well, there are a lot of people that are freaked. You'd be surprised how many people have called me and said, should I sell? Should I sell?